Assalamu alaikum. Hello guys, and welcome to this practice to pass session. This is your tutor Ijaz Khan, and I'm sure that I'm audible to each one of you, and you people can also view my screen. Before I formally start the session, let me discuss few things that how the things will be moving throughout these 5 days. First of all, definitely when we'll be moving ahead and I'll be discussing different parts of the syllabus, you will have questions in your mind. So what you people have to do is whenever you feel that you need to ask a question, just note down that question with you. And whenever I feel that this is the time when I'll be taking your questions, I'll just pause the lecture and then we'll take your questions. In this way, there will be less interactions, less disturbance in the lecture. Secondly, the course material, how will you be able to access your course material? In the chat box, a link has been shared and it will be shared again as well. So all you have to do is to access that link, and through that link, you will be able to download all the material that we are going to discuss during these 5 days. Thirdly, I have also created a WhatsApp group so that I'll be in touch with you during the session, after the session, till your exams, so that I can provide you maximum support that will help you pass the exams. For that, link has been shared with you for joining the WhatsApp group. Otherwise, you can also use QR code scanner, and this, right on your screens there is a QR code. So you can simply scan this QR code to join the WhatsApp group. So there are total 5 days. In the first 4 days, I'll be going through the syllabus areas, and I have picked questions from past exams to ensure that maximum syllabus area is being covered. So I've chosen different questions to ensure that when we will be solving these questions, the maximum part of your syllabus is covered. And besides solving these questions in these 3-hour sessions, I'll also be giving you daily assignments. And I'm trying to ensure that for each assignment, there is a video solution available as well wherever possible. So once you solve or complete your assignment, you will have the video solution of that assignment as well, which you can access anytime you want to. On the 5th day, we will be solving a comprehensive mock complete past exam question using the computer-based environment. So on the 4th day, I will tell you which past exam question you are supposed to solve. And on the very next day, I will solve that question, assuming that you people haven't attempted that question. So I'll be solving that question for you from scratch as if a student is taking that exam. So I'll be going through the exam. I'll be giving you tips how you should be solving different type of questions. And then till your exams, I'll be available with all of you on the WhatsApp group. So let's now start the session. As I told you that a link will be shared with all of you from where you can download all the course notes, the questions, the assignments, everything. So first of all, today, the syllabus area that we are going to start is the working capital management. The reason why I have chosen working capital management is that this particular part is a very isolated part from the syllabus. So even if somebody misses today's lecture and he joins or somebody joins from the second day, even the only part that student may have missed will be this working capital management. So it won't affect the rest of the days. So that's why I've chosen working capital management. It's an important part of your syllabus, and there will always be, that's my assessment, there will always be 5 to 10 or maybe more marks available for this part of your syllabus. So first, let me quickly go through the quick recap of what working capital management is, though this is a practice to pass session, and we will be focusing more on practicing the questions, but definitely a quick recap will always be useful. So I'll try to give you a quick recap wherever possible for the topics that we'll be discussing. So working capital management, what is working capital and what is the working capital management? Working capital, as you all know, if we just look at the formula, the working capital is current assets minus current liabilities, but that's just a formula. So let's quickly go through the concept of working capital, what working capital basically means. Working capital, every business, if we want to run a business, we need two types of investments in a business. An investment that is going to be for the longer period of time, like machinery, building, equipments. So these are the investments that we'll be needing for a longer period of time. We don't need capital for this type of investments every day. On the other side, we will also be needing investments for short-term period like inventory, which we call current assets. So basically, working capital is the amount of capital that we need for current assets. That is the things that we need on a daily basis. So inventory, receivables, cash, for example, a business definitely needs inventory to run day-to-day activities of a business. It also has to stuck some part of its capital into receivables, because if you have to compete in the market, you have to offer credit to your customers. So some part of your capital is going to be stuck into receivables. Then comes the cash. You need to hold cash for different types of transactions, paying for your expenses, paying to your creditors, or other cash transactions. So let's say, just assuming few figures, let's say a business needs $1 million for these three types of investments, $1 million. Of the $1 million, let's say it can get purchases on credit, let's say worth $200,000. So from $1 million, if it gets $2 million of inventory on credit, then the total required investment will be reduced by $200,000. So 1 million minus $200,000 will be $800,000. So this business will actually need $800,000 to run its day-to-day activities, and that $800,000 will be called working capital. So basically it is current assets minus current liabilities. Now this whole chapter is about managing these $800,000 from two aspects. Number one, the investment aspect. Number two is the financing aspect. First of all, a business has to decide how much to invest in these current assets. Definitely, the company cannot have a lower level of inventory levels because it may run out of stock and it will cost the company. It can't keep a high level of inventory, as it will be resulting in high holding costs. So, okay, I would just like to take a 2 minutes break for Azan, and I'll be back in just 2 minutes. So guys, welcome back. So we were discussing what working capital management is. So the first aspect of working capital is to decide how much to invest in these assets. And definitely, it depends on different factors that how much you should be investing in your current assets. So first, the company has to decide how much it has to invest, and we call it the investing strategy of a business. Investing strategy of working capital. Once the company has decided, let's say, like I gave you an example earlier, that let's say a company has decided to invest $1 million based on its circumstances, whatever the circumstances of the company are. So it has decided that it should invest $1 million, and now after it has decided that it has to invest $1 million, the second phase will be to decide how the company is going to finance these $1 million, what source of finance it has to choose. Usually, since these are for short-term base on a short-term basis, the priority will be to finance these investments through short-term financing. But sometimes the company has to choose a long-term source of finance for the working capital as well, especially for the permanent level of working capital. And when we say a permanent level of working capital, we mean the minimum that a business needs throughout the year. For example, I don't think there will be any business which will have zero level inventory in some part of the year. Definitely, there will have to be a minimum level of inventory that it has to keep throughout the year. But there will be some part of the inventory that will be fluctuating, especially if it's a seasonal business. So in a peak season, the business will have more inventory. In off-peak season, it will have a lower level of inventory, but there has to be a minimum level of inventory, which we call permanent level. Similarly, receivable, there will be a minimum level of receivable throughout the year. There will be a minimum level of cash that company needs to hold. So there will be a minimum level of investment in the current assets, and that is called permanent working capital. So, so usually the company would like to finance the permanent level of working capital through a longer term source. And for the fluctuating working capital, it will usually choose the short term financing like overdrafts, the credit account payable, or short term loans. So that aspect of the working capital where the company is deciding which source of finance it should use for financing the investment in the working capital, that part is called financing part of working capital management. So the whole working capital management is all about maintaining a balance between liquidity and profitability. Now remember this: if you keep more inventory, if you keep more level of receivables, if you keep more cash in hand, you will have less risk. You will have no risk of stock out since you have enough level of inventory. You will have no risk of running out of cash since you have enough cash available. So the risk will be low because you will be your liquidity position will be very good as you'll have more cash, more short-term investments that could be easily converted into cash. On the other side, since you will have more capital invested in short-term investments like inventory, like receivables, like cash, therefore you will be losing the profit that you could have earned by investing this capital into long-term investments. So you'll be losing profitability. So your liquidity position will be very good if you invest more in your working capital, but you will have to sacrifice your profitability in that case. On the other hand, if you keep lower level of inventory, lower level of cash, and you invest the additional amount of capital that you have freed up from not investing in the short-term assets, and you invest it in your long-term investments, so it will increase your profitability and reduce your liquidity and increase your risk. So if you go on to either extremes, going on one extreme will increase your will improve your liquidity and reduce your profitability. On the other side, it will increase your profitability and reduce your liquidity position. So a good working capital management will be to ensure that the company is safe enough, it has a manageable level of risk, and also it is able to avail a reasonable number of profitable opportunities as well. So the whole working capital management is about maintaining a balance between liquidity and profitability. That's why it's very important to have a good working capital management policy. So the whole working capital management revolves around this balancing of liquidity between creating a balance between liquidity and profitability. Okay, let's quickly discuss a working capital cycle. What is working capital cycle? Let's say if we have a manufacturing business, a working capital cycle for a manufacturing business will be, it will start uh, uh, buying raw material on a particular date, probably on credit. Then it will take some time for this material to get issued for production. Once it is issued for production, it will take some time to get processed into finished goods. Once it is processed into finished goods, it will be in inventory for some time before the inventory is sold to customers. And after being sold to customers, there will be some time period between receiving and selling the goods and receiving the cash against the goods. So that is the credit period that you will be allowing to your customers. So working capital management is basically the time period between the cash leaving the business, that is the day when you will be making payments for your purchases, and the time when you will be receiving the cash back from your customers. So say for example, you made a payment on the 1st January for your purchases, and on 25th of January, you received your cash back from your customers. So the working capital cycle will be of 25 days. That is called working capital cycle. So a quick question, I need all of you to respond to this. What do you think? Should a business have a shorter working capital cycle or a lengthier working capital cycle? What is good for a business? Exactly. Yeah, all of you are right. No business would like to have a lengthier working capital cycle because nobody wants the cash to be stuck up for a longer period of time. So everybody would like to have a shorter working capital cycle, and the whole working capital management is about keeping this life cycle as shorter as possible. Now there are ways you can shorten up this life cycle, working capital cycle. So quick answers. Tell me how a company can reduce the working capital cycle. Great. Most of you are giving the right answers. So number one, you have to shorten the time period of raw material issuance. So you have to issue the raw material to production as early as possible. So this will reduce your raw material days. Then you have to be efficient enough to convert the raw material into finished goods in the shortest time possible. So you have to increase your efficiency of production so that the inventory, the work in process is converted into finished goods. Then you have to ensure you sell these finished goods as early as possible, so reducing the finished good days. And then through a good receivable management, You have to ensure that you receive your cash back from your customers as early as possible. So there are different ways how you can do it, by offering early bird discounts, early discounts, cash settlement discounts. You can you can use the service of a factor we'll discuss later. So these are the ways through which you can shorten the working capital cycle. So how we calculate the working capital cycle? So we will be doing a question on it. So just a quick recap. So what you have to do is you have to add all these days. If it's a manufacturing business, then you will have raw material holding period. That is for how many days you keep the raw material in your stock. Then you have to calculate the work in process holding period. That is how much time it takes for a material to get converted into finished goods. Then you have to add the finished good days. That is for how long you keep your finished good in stock before the finished good could be sold. Fourth, the debtor collection period, that how much credit period do you allow to your customers, or how many days they usually pay you back. And last, you have to subtract from all the sum of these four the payable period. That is how long do you take to pay back to your creditors. The net balance will be called the working capital cycle in days. So you probably have to calculate these. So we learn how to calculate these with the help of ratios. So on this handout, I have provided every aspect of working capital management. So these are summarized notes, and these will be very effective once you are revising your syllabus areas. So there are different ratios here. So I'll just be quickly skipping these formulas. You can go through these formulas later. So here we go. These are the formulas, how we calculate these days. Account receivable collection period. The formula, this is a very common formula that you may have studied in your financial reporting paper, in your performance management paper, in your management accounting and financial accounting papers. So how do we calculate the average account receivable period? We need to have average account receivables divided by the credit sales and multiplied by 365. You will get to know for how long your customers take to pay you back. Then we have inventory turnover in days. For that, we need average level of inventory, whether it's raw material or it's the finished goods. So you need if it's for the finished goods, then you have to pick the average inventory of the finished goods and divide it by the cost of goods sold, multiplied by 365. And in case we don't have the average inventory, what we have to do is we have to add the opening and closing inventory and divide it by 2. But usually we assume the closing inventory to be as our average inventory. So in case we are not able to calculate the average inventory, we will assume that the closing inventory is the average inventory. Remember these key points. The raw material holding period, for the raw material holding period, we need inventory of raw material divided by, okay, they've given us the annual purchases, but most of the times we have to use the cost of material used during the production for the production during the year. In case it's missing, then we can use purchases, right? So just note this down. We'll usually use the cost of material used in production during the year in the denominator. In case we don't have it, so we can use the annual purchases figure, right? So let's move forward, and once we will be solving the question, I'll just explain what we have to use exactly. So now another quick area, and that is called over trading. Over trading. Well, what is over trading, and whether it's good for a business or not? That's what we need to understand. Over trading is when a business does not have sufficient long-term investment available, but is still trying to increase its sales. It does not have enough long-term investment available to back up its trading volume. For example, let's say, let me give you a quick example. Let's say if there is a pizza, a business of a business that uh, delivers pizzas. So let's say if they don't have heavy, big size ovens, it does not have a big size kitchen, it does not have enough delivery vehicles, but still it is trying to receive many orders, then it has the capacity to deliver. So if it does not have enough long-term asset backing, but still tries to do too much with too little of capital available, that is called over trading. A business has to trade looking at its capacity. Otherwise, that huge trading volume can backfire. Definitely, if you have to sell more, you need to have more inventory. You need to have a capacity of machinery to produce more units. You need to have a big factory space to store raw material, to store finished goods. You may have to have delivery vehicles to deliver this amount of goods to customers. So you need to have a balancing a long-term investment. But some businesses, in the anticipate in the haste of growing quickly, they try to increase their trading volume without increasing the long-term investment, and that is called over trading. This is basically a trap. So most businesses, they think it's an opportunity to have more sales, but basically that opportunity is a trap for the businesses, and it backfires because your orders will be delayed. You have to go for short-term financing because you don't have investments, long-term assets to keep as mortgage for long-term loans. So the the you will be relying too much on your short-term finance, and when your liabilities will fall due, you may not have cash available to pay off your debts, and you may move towards bankruptcy. So it's never ever a good thing to have over trading. Now, how a business is going to know that it is over trading? That's very important. There are symptoms of over trading. So a type of question that you may see, and you will be solving a question on over trading in a while. A type of question that you may see in your exams will be that it will give a performance of a company, and it will ask to perform few calculations and reach to a conclusion as to whether the company is over trading or not. So what symptoms have to be there in order to call a company as over trading or not? So number one, you will usually see a rapid increase in turnover, but keep one thing in your mind. This alone, this symptom alone is not a symptom of overtraining at all. If the business is increasing its long-term investment in line with the increase in the turnover, then it's not overtrading. So there has to be majority of these following symptoms in order to call a company as overtrading. So one of the symptoms is the rapid increase in turnover. So if you see a rapid increase in turnover in sales, then this will be one of the symptoms. Secondly, rapid increase in volume of current assets, right? So when you are increasing your current assets, they will be in the form of inventory usually, because if you want to make more sales, you need to keep more inventory. So your inventory will be increasing. Your receivables will be increasing because if you want to attract more sales, you have to give attraction to your customers. And one of the attractions that you may give to your customers will be the credit. So you will be offering more generous credit to your customers to attract more sales. So your receivable balance is going to go up. Right? So your current assets will be increasing in a higher proportion than your current liabilities. Only a small increase in equity capital. So you won't be increasing your long-term investment capital, that is equity or long-term debts. More trade payables because you will be relying too much on your trade payables as you will have less capital of your own. available. Bank overdraft will be increasing. You can simply check from the balance sheet of a company to see whether there is an increase in bank overdraft or not. So if you see a significant increase in the bank overdraft, this is another sign of overtrading. Um, Current ratio and quick ratio will fall. So you'll see deterioration in the current ratio and quick ratio, especially the quick ratio, because you'll be keeping more inventory. Your liquidity ratios and your gearing ratios, there will be deterioration in that, but we will be discussing the short-term liquidity, which is your current ratio. Okay, another important ratio will be sales to it will be asset for, let me write, increase in asset turnover ratio. Asset turnover ratio is sales divided by capital employed. So you will have less capital employed and more sales, which will increase your asset turnover ratio. So this is a very important symptom of overtrading. Now, how we will be finding out whether a company is overtrading? We have to calculate its current ratio, its quick ratio. So if we see that the current ratio has decreased, this is one of the symptoms of overtrading. Number two, if you see there is an increase in bank overdraft, that's another symptom. Third, we have to calculate asset turnover. If it's increasing, it means that the company is overtrading. If there is a significant increase in the sales volume, again, it's a symptom of overtrading. One more symptom, which is the reduction in gross profit margin and net profit margin. There will be reduction in gross profit margin and net profit margin. The reason why there will be reduction in these two gross profit margins will be the discounts offered. Because if you want to increase your sales, as I told you earlier, you have to give attraction to your customers. So when you'll be attracting your customers, one of the ways through which you can attract your customers is giving them discounts, promotions. So you'll be offering discounts, which will be reducing your gross profit margin in return. So if your gross profit margin is reducing, that's another symptom of overtrading. So there is a past exam question which we will be solving in a while to give you an idea of how we will reach to a conclusion whether a company is overtrading or not. Now, I'll just take a quick pause here and I'll just answer the questions that you've asked. And if there is any other question, you may ask as well. First of all, there is a question that how non-current asset will increase. Non-current asset will not increase. Non-current assets will not increase. That's one of the symptoms of overtrading, that your sales will be increasing, but you won't be increasing your non-current assets. So your long-term investment will not be increasing in line with your sales. Otherwise, if sales are increasing and we are also increasing our long-term investment, then it's not overtrading. Okay, so non-current assets will not be increasing as the sale increases. The next question is payable days will decrease. That's a question mark. She's asking that will the payable days decrease? No, the payable days will increase because you will be making your payments. You'll be delaying your payments because you won't have cash available to pay off your debts, and that is one of the reasons why overtrading is not good for a business. Okay, the quick ratio will fall because you will have your current assets will include a huge amount of your inventory. So when we are calculating quick ratio, we will have to deduct the inventory, which will be a significant amount. So that's what the reason why quick ratio is going to fall. The current ratio will usually fall. The reason why it will fall is that you will also have more current liabilities as well. There will be current liabilities. The company will be relying too much on the current liabilities to finance its investment requirements. So because of the payable, more payables, more current liabilities, it is going to reduce. So it will affect your liquidity position. So we have a question: what are the conflicts in working capital management? I guess you're talking about working capital management conflicts. The conflict in the working capital management is the liquidity and profitability, as I discussed earlier. If you keep more investment in your working capital, it will it will increase your liquidity position and reduce your profitability. If you keep less level of investment in your working capital, it will help you invest in long-term investments and increase your profitability. But on the other side, it will affect your liquidity position and will increase your risk. Now last question. I'll just take last question, and the rest of the questions you can hold, and I will answer on the WhatsApp group as well. So last question is, sir, how asset turnover is going to increase? The asset turnover will increase because we will be increasing our sales. So the numerator is going to increase, but we won't be investing more in our long-term investment. So the capital employed won't be increasing in the same way as our sales will be increasing. So this will result in a higher asset turnover ratio. Okay, so overcapitalization is the opposite of over trading. So when you have more capital available, when you have more investment available, you have enough capital available, but you are not able to capitalize that investment. You're not able to increase your sales. You're not able to increase your market share. You have investment, you have long-term investment available, but you are in some way or the other, you're not able to capitalize that investment. You are not able to take benefit of that amount of capital available. So you have a potential, you have a capacity to increase your sales, but you are not able to increase your sales. You haven't increased your sales. That's called overcapitalization. So neither over trading is good nor overcapitalization is good, and that is what working capital management is. You have to balance your trading value. You have to match your trading volume with your long-term investments. So now let's jump to the first question. And as I'll be moving forward, I'll be discussing other theoretical areas as we move forward. So again, if somebody hasn't joined the WhatsApp group, here is the QR code of the WhatsApp group. So you can use this QR code to join the WhatsApp group. And also in the link, the link to a WhatsApp group has been shared with all of you. So let's now start the first question of the day. So first, if you can just confirm, can you see the screen? Okay, so let me read the requirement first, and then we will go for solving the question. So now, whenever you are attempting any of your exam, whether it's performance management, financial management, or any other paper, always start with the requirement so that you know what you are up to. Okay, you need. Okay. Is it okay now? Okay, prepare the following forecast financial statements for APX company using the information provided. An income statement for the next year. We have to prepare a forecasted income statement, and we also have to prepare a statement of financial position at the end of the next year. So the information that we have, okay, by the end of this today's session, I will share this whole Excel sheet with all of you, and I'll tell you how you can get this worksheet at the end of the session. So I'll fill it and then I'll share this worksheet with all of you. So the information is APX company achieved a turnover of 16 million in the year just ended. Let me zoom it further. APX company achieved a turnover of 16 million in the year just ended. So it's the historic sales and expects turnover growth of 8.4%. That is important. So next year, it expects the sales to increase by 8.4%. Cost of sale in the year just ended was 10.88 million and other expenses were 1.44 million. The financial statement of APX company for the year that has just ended contain the following statement of financial position. So these are the assets and equity position of the business. There is the long-term bank loan has a fixed annual interest rate of 8% per year. APX company pays taxation at an annual rate of 30% per year. And the following accounting ratios have been forecast. This is for the next year. Gross profit margin that the company expects will be 30%, operating profit margin 20%, dividend payout 50%, inventory turnover period 110 days, trade receivable period 65 days, and trade payable period 75 days. All of these figures are forecasted for the next year. So these will be helpful in calculating the items of balance sheet and income statement. Overdraft interest rate in the next year is forecast to be $140,000. No change is expected in the level of non-current assets. So there will be no increase or decrease in the non-current assets, and we should ignore depreciation. Okay, my question to all of you is that tell me which statement should be prepared first, the income statement or the balance sheet? Yeah, most of you, yeah, almost all of you are correct. We should always have income statement prepared first, because the profit figure of the income statement, the retained profit figure of the income statement will be added to your equity, to your reserves, and then you'll be able to prepare your balance sheet. So yes, it's income statement that we need to prepare first. So it's a forecasted income statement. So we'll be taking the forecasted figures. So I have already prepared the structure. So let me first discuss the structure. It will be very easy. Now I'll also be telling you the technique that you should be using in these type of questions. First of all, if you have to prepare a forecast for income statement, first of all, you have to prepare the structure of your income statement. Once you know the structure of your income statement, then you will be knowing the components of income statement which we need to prepare this income statement. So sales followed by cost of goods sold, then gross profit, other operating expenses, operating profit, interest, PBT, profit before tax, then tax figure, then the profit after tax figure, then the dividends, and then the retained profits, which will be eventually added to your reserves. So let's start with the sales figure for the next year. So as you know, let me zoom in so that it's clearly visible. Sales figure. Now, the sales figure given in the question was 16 million, right? It was 16 million, but it has to be increased by 8.4%. So using the Excel, what we need to do is, okay, and I'm just producing these figures in thousands. So I've just put the heading in thousands. So the 16 million should now be 16,000. And we've just put these three zeros as our heading. So 16,000 into 1 plus 8.4%. So I'll just increase this 16 million figure by 8.4%. So $1,734,000 will be the sales for the next year. That's going to be your sales figure for the next year. So we are done with calculating the sales figures. It was too easy. We just need to increase the existing sales figure. Now about the gross profit. What is the gross profit? So with the help of the next year gross profit margin, we can calculate our gross profit. So that the following accounting ratios have been forecast for the next year. The gross profit margin is 30%. So just quickly tell me 30% of what? 30% of what? Yes, it's always of sales. So we'll just take 30% of the sales figure. So in the Excel, I will just keep on telling about the spreadsheet as well. So if you want to write a figure with a minus sign, a negative figure, just start the formula with minus. You don't need to use is equal to sign. So you can just simply start with the minus sign, just write 30% static and then refer to the cell of which you need to take 30%. So I just need to take 30% of the N6 figure. So here we go. I'll just enter, and that's the, sorry, I've just put it in the wrong cell. I'll just cut it here and paste it here. So I'll just have to put it here, gross profit. Five two three. Okay, this is a gross profit. I don't need to put it in the neg with the minus sign. 5203. Okay, and the cost of goods sold will now be the difference of the sales and the gross profit. So here we go. We have got the cost of goods sold figure as well. Right? So this is the gross profit. Now, other expenses, we don't know about the other expenses, but the question has given us the operating profit margin as well. So let's go back to the question and see what was the operating profit margin. The operating profit margin is 20%. So going back to the income statement, going into the cell of the operating profit, which is 20%. So I'll just take 20% of sales again. $3,469 is the operating profit. It is 20% of the sales figure. So in the same way, let's now calculate the operating expenses. It will be the difference between gross profit and your operating profit. So here we go. 1734 is our operating expenses. 3469. Now the interest. So we have two types of interest in the question. One is the interest on long-term loans. The long-term bank loan has a fixed annual interest rate of 8%. 8%, right? So a quick question from all of you. Tell me, is there any increase in non-current liability? Has the question mentioned anywhere that we are going to increase our long-term liability? No, right? So there is no increase in our long-term liability. Therefore, we should get the same long-term liability that was given in the question for last year. So the long-term liability figure, the long-term loan is 10 million and interest will be 8% of this figure. So one type of interest is 8% of the loan, that is of the 10 million. And the other thing, the other type of interest is the interest on overdraft. The figure has already been given, which is 140,000. So this is where most of the students will make a mistake, and they will just take the interest on long-term loan and will ignore the interest on overdraft or vice versa. So we have to take both. So it should be 8% of 10 million, which will be 10,000, plus 140,000, which we should write as 140. So 8% of the 10 million loan plus 140,000, we should not write the 3 zeros. So we should just take the 140 figure. 940. Okay, Asad is asking a question that, sir, the other expenses mentioned in the beginning of $1.44 million. Asad, that was for the last year. That was for the current year, which has just ended. We are preparing forecasted income statement for the next year. I hope it's clear, Asad. So what is 140 again, please? 140 is the interest on overdraft given in the question. You people can also download this question from the handouts as well. This question is also present in the handouts. This is the figure, 140,000. Overdraft interest in the next year is forecast to be 1,40,000. Okay, so I have just picked up two types of interest. Let me go through again. Go through it again. 8% of the long-term loan plus the 1,40,000 interest on overdraft. So it's 940,000. So let me subtract it from our operating profit to get the profit before tax, 2529. So what's the tax rate? What's the tax rate? The tax rate is 30%. No, I haven't taken 8% of 140,000. I haven't taken one. Just look at the formula. I've just taken 8% of the 10 million and then added the 140,000. Okay, the PBT, the profit before tax, is 2529. Now let's take the tax. Tax is 30% of the PBT. Here we go. We have got the tax figure, and after tax figure will be 1770. That's after tax. So how much dividend we are supposed to pay? Who's going to tell me? How much dividend are we supposed to pay? %50, right? This is the payout ratio. The dividend payout ratio is 50%. That is, whatever profit we are left with, we should be paying 50% of that profit as our dividend. So 50% of the profit after tax, 885. And now we are left with the profit that we will be investing in the business, that is So are you getting my voice now? No? Okay. So let's move forward now. Now we are done with our income statement, and the retained profit for the year is $885,000. Now it's time to prepare balance sheet. So in the balance sheet, we will keep those things that were not changed. So we'll just copy paste the last year figures and show it as the current year figures. And one of these were non-current assets. So non-current assets, as per question, were not supposed to increase. So no change in expected level of non-current assets. So we'll just write the figure as it is. So the non-current assets were 22 million, and I'll just write 22,000 as it is, right? Okay, so 22 million is there. Now let's calculate the other figures, the inventory, the trade receivable. Now quickly, who is going to tell me how are we going to find the inventory figure? Should we keep as it was last year, or we should use something to calculate the inventory figure? Yes, we will be using the formula of inventory days to find out the inventory, right? So let me quickly write the formula of inventory days here, and then we will be using this formula. So the formula was inventory divided by cost of goods sold into 365, right? So this will be the formula for calculating inventory days. So we have to change this formula to calculate inventory now. So if we want to calculate inventory, the formula has to be changed. So the cost of goods sold, which is in the denominator of this side, will be multiplied with the inventory days, and 365, which is multiplied here, will be divided on the other side, right? So the formula will now be inventory days into cost of goods sold whole divided by 365. So just use your calculators, just take out your calculators and do this calculation quickly. Similarly, I'll just write, meanwhile, I'll be writing the formulas for these two figures, right? So use your calculators. Inventory days will be replaced by account receivable divided by sales, sorry, multiplied by sales whole divided by 365. So let me calculate now for all of you. So we need to pick the inventory days. So we have to go back to the question, and inventory days were 110, and the sales figure will be picked from the income statement. So I'll just be referring to the cell. So inventory days 110 into the sales figures. The sale figure will be 17344. I'll just refer it to the cell. I don't need to reproduce this figure. Now remember one thing in the spreadsheet. If you already have a figure written in a cell, and then later on you have to use the figure, do not write it again. The reason is, if the examiner has to check your working, he will have no idea from where you have picked this figure. Now, since I have referred N6, he will go back to N6 and check what formula I have used here to calculate the sales figure. So he will have all the figures there, all the workings there. So refer it to the cell. Remember this, into 365, sorry, divided by 365, right? Five two two seven. This is okay. Sorry, I'm sorry. I was just trying to calculate the receivable. So we will be using the cost of goods sold figure, and that is the cost of goods sold figure. But the cost of goods sold figure was negative, so I have to write the minus sign here to keep it positive. Yes, thank you for correcting. Thank you for correcting. Yes, it should be cost of goods sold. So I've just corrected it. It's N7, that is cost of goods sold. 3659 is your inventory figure. Now trade receivable. For that we need receivable days. Let's go back to receivable days and see. Trade receivable period was 65 days. So we'll be using 65. $65 into sales. Now this time we will be using sales. Here we go. And then divide by 365. Divide by 365. So it's 3089. So we have got the inventory figure, we have got the trade receivable figure. So we are done with two types of current assets. Now let's add these two together. As we don't have cash, $6748. So the total assets will now be the sum of non-current assets and the current assets, 28748. So that's one part of your assets balance sheet. Now the tricky part comes here. Now I want you people to listen carefully. That's the tricky part now which I'm discussing. This business expects to have a total investment in its assets equal to 28748. But this investment has to come from somewhere, either through equity, through long-term debts, or through short-term liabilities. But this has to come from somewhere. Now, a quick question from all of you. Is the company going to increase its share capital? Has anywhere it mentioned that it intends to increase share capital for the next year? No. So from $28748, share capital is already there. The share capital was this equity finance thing. It is 5 million, which means 5,000 that we need to write. So of the 28748, 5,000, 5 million are already available through equity finance. So just for memorandum purpose, you don't have to do it in your exams. Just for memorandum purpose, I'm subtracting 5,000 from the total asset figure to see how much is remaining to be financed. So of the 28748, 5 million is coming through the share capital. 23748 will be the remaining amount. Now, the next source of finance is again the equity one, but that is the reserves. So will there be any increase in the reserves? A quick question. Will the reserves increase? Yes, the reserves will increase because of the retained profits. So we'll just pick the reserves that were given in the question, and then we will be adding the retained profit of the current year. The existing reserve figure was 7.5. The existing reserve figure was 7.5. So in the 7.5, we have to add the retained profit for the year. This will give us the total reserve figure. So this is again a common mistake that most of the students will make. They will just forget to include the retained profit in their reserves. So 7.5 means 7,500 plus just refer it to the cell. Instead of writing 885, you have to refer it to the cell. So I've just referred it to the cell 885 and I've added the reserves, existing reserves figure. So 8385. Now out of 23748, a further amount of 8385 is available through reserves. So let me subtract this figure again to see what is remaining to be financed. Now we still have $15,362 to be financed because these investments have to be financed. So we are left with 15,362. Now let's come to the current liability figure. No, sorry, long term. So Are we increasing the long-term capital, long-term liability for the next year? Are we increasing the long-term liability? No. It will remain the same, right? Nowhere it is mentioned in the question. Remember one thing, we cannot increase the long-term liability from our own. We have to look at the question. If the question isn't asking us to increase, we can't increase. So let's keep it 10 million as it was. So the long-term debts will be 10 million, that is $10,000. So of the 15362, 10 million will be financed through long-term debt. Now we still are left with $5362 of financing. We have to finance this 5362. Now comes the trade payable. For trade payable, again, we have to use the formula of payable days. And the formula is going to be payable days into cost of goods sold, though usually we use purchases. But since in the question we don't have the purchases figure, so write it somewhere, write down somewhere that the normal formula for payable days will be using the credit purchases. In the absence of credit purchases, we use cost of goods sold. So as far as possible, use the credit purchases figure. So multiplied by cost of goods sold and a whole divided by 365. This will give us the payable figure. So let's go to the question and see what were the payable days. The payable days were 75 days. Okay, so let's go to the payable 75 into the cost of goods sold. We'll just simply refer it to the cost of goods sold cell, which was 12141, and then whole divided by 365. 3 whole divided by 365. Since the cost of goods sold figure was with a minus sign, so I have to put a minus outside the bracket so that the ultimate sign is changed to positive 2495. Now, what are we left with? 5362 minus 2495. So what are we left with? 2868. Now, what source of finance are we left with? What source of finance are we left with? The only source of finance that we are left with is the overdraft. So this rest of the amount is going to be financed through the overdraft. And that amount should be $2868. Now I can't simply write $2868, otherwise the examiner will be confused at how come I arrived at this figure. So I have to use a formula. Now the formula will be a very simple one. Look at it. The total amount, total investment in the assets was 28748, right? From this, we have invested 5,000 minus 8385. This is the investment through equity, then minus 10,000, and then minus the trade payables. So the resulting figure will now be the overdraft. $2868. $2868. That's the overdraft figure. And now the balance sheet will be balanced. 5362. And the total equity figure will be the sum of these two, right? And this is the total equity figure. This is the 10,000 figure. And now then we have current liability. And here we go. We have a balanced balance sheet. $28,748. So for the next year, this is what our balance sheet and income statement should look like. Dua, we usually don't write the equity and any figure on the balance sheet as negative figure. Okay, Huma, I'm just going to give a break for a while. There's no harm in giving a 2 minutes break. Don't worry, inshallah, I will cover the syllabus. No, we don't have to take extra pressure on us. I'm always against taking extra pressure. We have to study in a chilled environment, right? So if there is any need of a break, I'm very much good with it. So I can give you a 2 minutes or 1 minute break. No problem. So I hope you people have seen the formula. Okay, I can just cut short the formula for the overdraft because I've already calculated the total equity figure. So I can just simply take this total asset figure. From this, I can subtract the total equity figure instead of separately subtracting these two, minus the total long-term debt and minus the trade payable. So I don't need to write these figures. Just let me subtract all of this. I don't need to show it to the examiner. Okay, so I'm just taking a 2 minutes break. Meanwhile, you people can ask me any question that you want to ask. Current liability. Which current liability you're talking about, Daniel? No, Daniel, who asked me the question? Abdul, the same. We have done the same thing. We have done the same thing, exactly the same thing. Sir, is the working capital cycle and cash operating cycle? Well, when we talk about cash operating cycle, to be very precise, cash operating cycle is basically um, when you receive your cash from, it's basically the differentiation between you receive your cash and you pay your cash. That's to be very precise. But these terms are interchangeably used. Okay, we have a question. Is it necessary to tell examiner about using cost of goods sold instead of using credit purchases while calculating the value of payables? No need to. No need to. It's very much understandable if you don't have the purchases figure available, you can always use cost of goods sold. So you don't have to tell the examiner. Robert says, which topic are we currently going through? We are going through the working capital management. Okay, how we have calculated the 5362 figure? It's the sum of these two. The two trade payables will be the total current liability. It's the sum of these two. Shamir, yes, I will explain, but keep this question and do remind me later. First, let's move towards the next question. Uh, a link has been shared with all of you, and it will be shared in a while as well to access all the material. Otherwise, I have also created a Google Classroom for all of you, the details of which I'll be sharing on the WhatsApp group after the class. So all of you can join that Google Classroom to access all of your material. It will include day-wise material. It's a very structured thing. So you will be getting all the day-wise material on that Google Classroom. Okay, so now let's move forward, right? So let's go to the next question. So I have picked these questions so that we can cover maximum syllabus area. So let me, okay. Is it clear? Is the question clearly readable? Can you people just confirm? Okay, so let's read the question. Calculate the annual cost of ordering policy. Ignore financing costs in this part of the question. So this particular part is related to your inventory management. Then next part is calculate the annual saving if the economic order quantity model is used to determine an optimal ordering policy. Ignore financing costs in this part of the question. So both these parts are related to inventory management. So let's calculate. TNG company expects annual demand for product X to be 255380 units. And product X has a selling price of $19 per unit and is purchased for $11 per unit. So let me quickly write the formula of EOQ with you. So this is the formula. I hope it's visible on the screens. 2 into C naught into D divided by CH, cost per order, into annual demand divided by CH. The EOQ is basically the number of units that you order at a time so that you can minimize your inventory costs. So first of all, it has asked us to calculate the current ordering policy cost, right? So whatever the current ordering policy is, we have to calculate its cost. So current cost will be equal to your purchase cost. If it's there, yes, it's there, purchase cost. And purchase cost is always equal to your annual demand into price per unit. So what is the annual demand? TNG places an order of 50,000 units for product X at regular intervals throughout the year, right? So 50,000. So what is the annual demand? The annual demand is 255380. So 255380 into $19. So that's purchase cost, right? I hope it's clear. The purchase price, which is $19. Sorry, it's $11. $19 is its selling price. So it's purchased at the rate of $11. So 255380 units are purchased at a price of $11 per unit. That's the purchase cost. Then we have ordering cost. Ordering cost, I will just write the formula here. The ordering cost is equal to number of orders multiplied by cost per order. So we have to find out the number of orders that we'll be placing throughout the year, and we have to multiply it with cost per order. So the cost per order is already given in the question. The cost of placing an order is $25. So it's $25 multiplied by the total number of orders. Now we have to calculate that number of orders because we don't have the number of orders given in the question. So the annual demand is 255,380. This is what we need to order in total. And each time when we place the order, we order 50,000 units. So in order to calculate the number of orders, we have to divide our annual demand by the order size, which is 50,000. So 255,380 divided by 50,000 will give us the number of orders. That is going to be the number of orders. And 25 is the cost per order. So if we multiply it, this is what we get. 127.69. So let us make it 128. Right? Okay, now let's calculate the ordering cost, holding cost. Holding cost will be equal to, now let me write the formula for holding cost. The formula for holding cost is the average stock, and in the bracket I'm writing the formula for average stock. The formula for average stock is buffer stock or safety stock, whatever you call, plus order size, and the order size has to be divided by 2. So buffer stock plus order size divided by 2, this will give us the average stock. The formula within the bracket is for the average stock, and then multiply it with the holding cost per unit per annum. Make sure it's per annum. Holding cost per unit per annum. So let us first calculate the figure in the bracket. What is the buffer stock? It says that the buffer stock has to be for 28 working days. 28 working days. We need to have a buffer stock or safety stock equal to 28 days demand. So again, we have to calculate the per day demand and then multiply it by 28 to get the buffer stock. So instead of making it complicated for you, what I'll do is I'll just do some working here, right? Just for your sake. Otherwise, we have to do it within a single formula. It will be much easier for the examiner to check, but I don't want to make it complicated for you. So first, I'm just calculating the daily demand. The daily demand will be equal to the annual demand, which is 255,380, and I'll divide it by 365. So this is the per day demand. And it says the buffer stock should be for 28 days. So all I have to do is to multiply 700 by 28 to see how much we need for 28 days. 19591. So that is going to be our buffer stock. So I'll just simply refer to this cell, buffer stock plus the order size divided by 2. Order size is 50,000, and if we divide it by 2, it will give us 25,000. So within the bracket now we have the average stock, the buffer stock, and the order quantity divided by 2. And now let's multiply it with the holding cost per unit. What is the holding cost per unit? And the storage cost for product X is 10 cents per unit per year. Now most of the students under the exam pressure will treat it as $10 and multiply it by 10. You should not do this mistake. You should multiply it with 0.1. So that's the holding cost. Okay, that's the holding cost. I hope it's clear. Is it clear? A quick yes. If it's clear, just write yes. Okay, thank you. So it's the holding cost. Now let's add all these costs together to get the total cost of the current ordering policy. That's your answer. Total cost. So that's A part. So we are done with A part A. Okay, so a quick recap. The annual purchase cost will be calculated as annual demand into the purchase cost per unit, 11. Then comes the ordering cost. For the ordering cost, we need to have cost per order, which is $25. multiplied with the number of orders. For the number of orders, we have to divide the total demand for the year by the order size, which is 50,000. So when we divide it by 50,000, we'll get the total number of orders. And if we multiply it with the cost per order, we'll get the total ordering cost. For holding cost, we need buffer stock plus the order size divided by 2 to get the average stock. So within the bracket, this is average stock. And if you multiply it with the holding cost per unit, we will get the total holding cost for the year. So we have three components for our total cost: the purchase cost, the ordering cost, and the holding cost. Here we go, 2813767. Now it says that what if we move towards the economic order quantity model? So for the economic order quantity, what we need to do is we have to find out the EOQ first. That is how much we should order at a time. Instead of ordering 50,000 in each order, it says how much we should order so that the cost is minimized. So we need to find out the EOQ. So for EOQ, we need three things: the cost per order, the annual demand, the holding cost. We need to multiply these three, divide by CH, and take the whole root. Now, how we are going to do it? Let's check it out. So I will be opening two brackets. So 2 into C0, which is 25, into annual demand, 255380. That's the numerator part. Now divide by 0.1, that's the holding cost, bracket close. And then we have to take its square root. So the best way to take a square root will be to take a power 1 upon 2. So a square root could be taken as power half. We can take half power, which is equal to the square root, right? Daniel, I'll get to your question. You will just get it once I do it. So that's how we calculate the EOQ. So it's 11,300 units. So EOQ is 11,300 units. What does this mean? It means that instead of ordering 50,000 in every order, the company should order 11,300 units each time it places the order. And if it does so, its total inventory cost will be minimized. So are we supposed to calculate the cost as well? Calculate the annual saving if the EOQ order is made? Yes, we have to calculate the total cost, and then we have to see how much we are saving if we switch to this EOQ. Yes, sir. Salman, you can, sorry, Jonathan, you can also use this square root function. You can also use the square root function, but students may forget to use it. That's why I've kept it very simple. Just take a power of 1 upon 2. Okay, so now let's calculate the total cost again. Total cost again. So the total cost will again include these figures. So I'll just copy paste them. It's easy for in spreadsheet, you can reuse the calculations that you've done. So purchase cost, in the purchase cost, there will be no change. Why there is not going to be no change? Because the annual demand will remain the same. And since there is no discount available on buying more, there is no discount. There isn't any discount, right? This discount is the cash discount, not the trade discount. So this is related to the early settlement one. So it has nothing to do with this. So even if you order more units, you still have to buy it for $11. So there will be no change to your purchase cost. Now let's come to the ordering cost. The cost per order will remain the same, 25. The annual demand will remain the same, but now we are not ordering 50,000 in each order. We are ordering 11,300 since we have already calculated it. So I will just refer it to this cell. So 565. Then comes the holding cost. In the holding cost part, Daniel, now I'll be answering your question which you asked. In the ordering cost, the buffer stock is going to be the same. There will be no change to your buffer stock. So I won't be changing this. Instead of writing 50,000, the order size, now we'll be writing the EOQ because now we are using EOQ as our order size. So 11,300 should be divided by 2. and then multiplied with the cost per unit per annum, 565. So this is going to be our cost, and if you can just check it out. The earlier cost was more than this cost. So now let's calculate the saving. If we switch to our holding cost, saving in cost will be equal to 2813 minus 2810. That's the saving. This is our answer. That's part B for you. Just wait. No, these will not always be safe. I have made a mistake, which is that this is O12. We should not be taking O12. We should be taking the buffer stock, which is 9591. So it should not be always same. Usually it will be same. When there is no buffer stock, the holding cost and ordering cost will always be same if you are using the EOQ model. So I'll just write it here. If there is no buffer stock, the holding cost and ordering cost will always be same when using EOQ, but only when using EOQ. So this is the formula that I have used for calculating the holding cost. Mohammed Adam, I hope I've answered your question. Okay. So that's what we have calculated now. The next part says determine whether the discount offered by the supplier is financially acceptable to a TNG company. Now let's see what is the offer. TNG company normally buys trade suppliers after 60 days, but MKR has offered a discount of 1% for cash settlement within 20 days. TNG company has a short-term cost of debt of 8% and uses working year consisting of 365 days. Now what we have to do is to say whether it's good to have this discount, right? So TNG, the company that we are working for, right? And it has been offered, it normally pays in 60 days, but now it has a choice. Either it continues to pay with pay after 60 days, or it pays excuse me, or it should pay within 20 days and get a 1% discount. TNG company has a short-term cost of debt of 8% and uses a working year consistent of 365 days. So should it go for this discount or not? That's what we need to calculate. So first of all, let's understand this concept. Okay, first of all, let's see, in order to get this discount, what it has to do. It has to make a payment in 20 days, right? Or otherwise, it can still make this payment in 60 days. In order to make this payment in 20 days, it has to borrow, and it has to borrow at 8% per annum. Now, this 40 days early payment will help it to get 1% discount, right? 1% discount. But on the other side, it has to pay early. And for paying this early, it has to borrow the money at 8%. Now, what we have to do is we have to compare how much annual discount it is going to get. This is not the annual discount. This is the discount that it is going to get each time it pays 40 days earlier than its normal work payment period. So this discount is basically for 40 days, right? This is for 40 days. So we have to calculate the annual discount and compare it with the finance cost. Discount in this case is a benefit for the company. And to get this benefit, it has to pay a cost of 8%. So what we need to do is to find out the annualized cost of annualized benefit and compare it with this 8%. If the annualized benefit of discount is higher than 8%, we will accept, otherwise we will reject. So the formula for calculating the discount is, first of all, we have to calculate T, right? We have to calculate T, right? T is basically the difference between the normal time period and the discount period. In this case, the normal period is 60. The discount period is 20. So T will be 40, right? This will be 40. Okay. Now the formula will be, let me write it with the help of the pen. I hope it works fine. The annualized cost formula is 1 plus the discount percentage divided by 100 minus the discount percentage, whatever the percentage is, raised to the power 365 minus T, then minus 1, and then whole divided by 100. Excuse me for the writing. Okay, that's the formula. So let us use this formula to see what is the annualized cost of discount. Annual benefit. In this case, it's a benefit because the discount will be received. Annual benefit. So the formula is 1 plus the discount. How much is the discount? How much is the discount? 1 divided by 100 minus 1. 100 minus 1. This is what you should always write. 1 divided by 100 minus 1. Okay. Raised to the power 365 divided by 40. The T that we just calculated. Okay. Okay. Now I am not multiplying it with 100. I will use the function of the spreadsheet, right? So let me first calculate this, and then I'll just select the format of percentage to get a percentage sign. What mistake did I do? Okay, okay. Sorry. Did I do any mistake? Okay, let me write 100 minus 1 directly as 99. Probably. What mistake am I doing? Okay, let me check it. One plus 1 divided by 99. Okay, then I should take power 365 divided by 40. Then at the end, I should subtract 1. So here we go. It's 9.60%. So the annualized benefit is 9.6%, right? So this is what we are going to get on in annual terms, 9.6%. Now to save 9.6% or to earn 9.6%, we have to spend 8%. So what do you people suggest? Should we go for it or not? Yes. So we should go for it. So the annual benefit is 9.6%, whereas the cost of interest is 8%. So what we'll do is we will just borrow the money at 8% and pay the supplier earlier. So we'll be spending 8% on one hand. On the other hand, we will be saving 9.6%, or we'll be getting 9.6%. So it's a win situation. So is it clear? Okay. As far as the theory part is considered, discuss the advantages and disadvantages of using just-in-time inventory management. The advantages and disadvantages are already provided in the handouts. So you just go through the handouts, and in case you don't understand anything, just get back to me on the WhatsApp group. Just let me. Okay, I'll just show you the QR code of the WhatsApp group. I hope you people have a QR code scanner. Again, I did the same mistake. Let's keep it 99. So I'm showing you the WhatsApp group. This is it. And this link will be shortly shared with you in the chat box, so you can use it from there as well. Otherwise, you can use the QR code. Just take the screenshot of this and use your QR code scanner. It is usually there in your cell phones. Okay, let's move forward. Ulnad company has annual sales. So let's read the requirement. Evaluate whether the proposed changes in credit policy will increase the profitability of Ulnad company. Okay, just quickly take the screenshot or take this picture from your cell phone of this QR code. Okay, in case but you are not able to join the WhatsApp group, I'll just share the link in a while. Otherwise, I will share my contact number with all of you. Okay, let's go to the Ulnad company. Ulnad company has annual sales revenue of 6 million and all sales are on 30 days credit. Although the customers on average take 10 days more than this to pay. Now, a very a very important a very important thing to note, and most of the students will make the mistake. So you should not be making this mistake. Look at this sentence. It says Ulnad company annual sales revenue of 6 million and all sales are on 30 days credit. This is the company policy to give 30 days credit period. But this is not what we should be using at all. It does not matter how much time period the company gives. It's always what the customer takes. The customer on average take 10 days more than it's this to pay. So for us, 30 is not important. What should we use? We should use 40 days as the current credit period, because effectively if it's 40 days, then we should be using 40 days. What is there on the papers does not matter. So we should be using 40 days, right? This is a trick of the question. Contribution represents 60% of the sales and the company currently has no bad debts. Account receivables are financed by an overdraft at an annual interest rate of 7%. Now, what is the plan of Ulnad company? Ulnad company plans to offer an early settlement discount of 1% for payment within 15 days. Now, if any customer who pays within 50 days will be paying 1.5% less than we owe, and to extend the maximum credit offered to 60 days. So either pay within 50 days or pay after 60 days. The company expects that these changes will increase annual credit sales by 5%, a very obvious increase, because when you give attraction of credit period to your customers, extension of credit period, then it increases your sales. The company expects that these changes will be 5%, while also leading to additional incremental cost equal to 0.5% of turnover, but it will increase your administration cost or whatever the cost is by 0.5% of the turnover. The discount is expected to be taken by 30% of the customers. Very important. Not all the customers will be taking this discount. So it means that 30% of your customers will be paying within 15 days, whereas 70% of your customers will be paying within 60 days after this policy is being introduced. Okay, so now what we need to do is we have to find out the impact on its profitability, and then we have to see whether the company should offer this or not. But definitely we have to look at it from a financial perspective. So let's do calculation A. First of all, we need to calculate the benefit. Now the benefit in this case, one of the benefits in this case is the additional contribution that we are going to get by offering this. So the additional contribution is going to be, first of all, we need to find out the additional sales, the existing sales figure, which is $6 million. So again, I'll write it in thousands. Should I zoom in? So additional sales figure 6 million into 5%. But definitely if the sales volume will increase, our variable cost will also increase. So we have to pick the contribution. So what is the contribution ratio? 60%, right? Our contribution is 60%, so we should be taking 60% of the additional sales. I hope it is clear. So it is going to be one. Okay, the figure isn't that big, so we can simply write it in thousand in a normal way. Yes, no. Why 1.05? Why 1.05? Why should we be including the 6 million? The 6 million sales is going to be there, irrespective of whether we offer this discount or not. We should be taking the additional sales figure, which is the result of this policy. Rubed, right? The relevant costing approach. We should pick up the incremental benefit of the policy. The sales of 6 million will always be there. We should only pick the additional sales that we are going to get because of this policy, and the additional sales will be 5%. And then we will be taking 60% of this additional sales to get the contribution figure. Is it clear, Rubed? Rubed, is it clear now? Okay, so that's 180,000. Okay, now we need to find out the additional costs. Additional costs will be, one of the costs is that 0.5% incremental cost. So other cost, let me write it as other cost. So it's 0.5%, 0.5% of turnover. The turnover now will be the total turnover, right? In this case, we will be taking the total turnover, not the additional turnover, because this cost was never there before. So 6 million, which is the existing sales, into 1.05, that is including the additional 5% sales. So the total sales after this policy will be this will be the total sales after the policy, and the incremental cost will be 0.5% of this total sales figure. Sharos, we will be including, just wait. That's why I have created a gap, because at the moment we don't know whether the finance cost will be increasing or decreasing. So I've just left the finance cost for a while. So I'm just taking the obvious things first. So the other cost will now be 31,500, right? Then we have a cost of discount, right? Discount is 1.5%, but only 30% of your total customers will be taking this discount. So first, let's take the total sales figure. The total sales figure will be 6 million into 1.05. Then we should take 30% of this figure, because only 30% of the customers will take this. And then we should multiply it with the cost of discount, 1.5%. So 6 million, the existing sales figure, but since after the policy, the sales will increase by 5%. So I've just taken 1.05 of this. Only 30% of the customers will take this discount. So I just took 30% of it and then multiplied with the cost of discount to get the cost of discount for the year, 28,350. Now comes the finance cost. Now comes the finance cost. Now, this discount has been offered to decrease the finance cost. So definitely in this case, the finance cost is going to be the benefit. But it's not always the case. Sometimes it may increase the finance cost due to some other factors. So let us calculate the finance cost as well. Saving in finance cost. Now, how are we going to calculate the saving in finance cost? For this, I will just go to the working section so that you can understand. So finance cost will basically be saved because of the reduction in your account receivables. If you have more account receivable, you'll have more finance cost because you will have more capital stuck up in account receivable. If you have less account receivables, you will have less finance cost. So let's calculate the account receivable balance before the policy and the account receivable balance after the policy. We already discussed the formula of calculating the account receivable. So existing account receivable will be calculated as the account receivable days. What are the current days of account receivable? Just quickly, what is the current account receivable days? What are the current account receivable days? 40 days, yeah. 40 multiply by your credit sales, 6 million, because the existing sales are $6 million. Okay, then divide by 365. In F9, we will usually assume 365 days in a year, but if the examiner says otherwise, we will be using the other figure. So that's our existing account receivable. This is our existing account receivable. Just look at the formula. 40 multiplied by the existing sales divided by 365. Okay, then revised account receivable, or we can call it as the receivable after the policy. Now it will be divided into two categories. The one taking the discount, the other not taking the discount. So those paying within 30 days for 15 days. And paying within 60 days. So we have to calculate it twice. So now within 15 days, for 15 days, we will pick 15 as our factor, 15 multiplied by the sales. Sales will be after the policies. The sales will be the sales after policy. Screen is paused. It's working at my end. So 15 into the revised sales figure, which will be 6 million into 1.05, but only 30% will take the advantage of this discount. 30%, so we'll take 30% of it. And then divided by 365. So 15 into revised sales figure into 30%, because only 30% people will take this. So shouldn't we take 1.5 discount in revised accounts? No, usually we don't consider the discount here, because if you take balance sheet figure, you know that on a balance sheet we take the gross sales figure. So usually we don't consider that 1.5% here, but it's a very subjective matter. A few people they take this discount figure here, and few people they don't. So usually you should not be taking that discount figure. So you can simply ignore that discount figure here. So we should consider this as our sales, because this is what our sales figure will be. Because discount is considered as a cost, not a reduction in sales. And let me copy paste this formula again with some changes. So instead of 15, we should write 60 here, 1.05, and then instead of 30%, we should write 70 here. And now let's add these two figures. Total account receivable after policy. Right? So saving in finance cost. Now let's take saving in finance cost. First of all, let's take the difference of the account receivable figure. Has this account receivable figure increased? Why has it increased? Yes, it is increasing, because the credit period has been extended from 40 days to 60 days. So it has increased your account receivable. So it's no more a benefit, it's actually a cost. That's why I told you that sometimes it will be cost and sometimes it will be a benefit. So in the spreadsheet, we have a benefit that we can first calculate and then place it accordingly. So it's a discount, it's a cost. So we can say increase in finance cost as the account receivable is increasing. So what's the difference in account receivable? 802,602 minus the existing receivable, and then multiplied with the finance cost. What is the finance cost of the company? It's 7%. So take 7% of it. So this policy is going to increase our finance cost by 10154. So remember this thing, as I told you earlier, the finance cost will not always be a benefit. It may be a cost or it may be a benefit. So just first calculate what is the impact of the policy on receivable. If you see the receivables are increasing after the policy, it means it will increase your finance cost. So the finance cost should be shown as a cost. If you see that the receivable figure is decreasing, if you see that the receivable balance is decreasing, it means that it will result in a saving of finance cost. So it should be shown in the benefit side. So let me give you a quick recap. Before the policy, we had a receivable balance of 657,534. After the policy, we have two types of receivables. The ones paying within 15 days, which is 15 into the revised sales figure, 30% of the customers who are taking the discount divided by 365. So it will be 776,671. Then the people who are going to pay us within 60 days. So 60 into the revised sales figure into 70% the people who will be paying within 60 days divided by 365. Now, if we add these two figures, we'll get the total account receivable after the policy. The total account receivable after the policy will be higher than the existing, and it is because of a very obvious reason. Earlier, the customers were paying within 40 days. Now they will be paying after 60 days. 70% of them will be paying after 60 days. And also the sales have increased. Earlier, our sales were only 6 million. More sales, more receivables. So the sales are also increasing. So because of these two reasons, our finance cost will increase. Now the total cost will be the sum of these three. We don't have any other cost. So additional costs will be, let me write as a negative figure, better to write it as a negative figure. Okay, and then let's subtract from the above. 180,000 was the benefit. 70,000 approximately is your additional cost. So the net benefit of the proposed policy is 10,995, and let us write it to 0 decimal place. So that's the net benefit. So what should we do? Should the company offer this discount? The other cost was simply 0.5% of the revised sales figure. 0.5% of the revised sales figure. What do we call it? It hasn't named this cost. It's just simply said that there will be additional incremental cost equal to 0.5% of turnover. Probably it's the administration cost, or maybe it's the bad debts cost, or I don't know, whatever the cost may be, but it hasn't mentioned what type of cost it may be. So usually it is going to be the administration cost, because more sales, more credit period, it will increase your administration costs. So everybody just respond. Should this policy be implemented? So if you are supposed to write a comment which is not, which they haven't asked us to do, so if they want us to comment on the policy, so the comment is usually whether it should be accepted or not. Since there will be an increase in the profit, therefore the policy should be implemented on financial grounds. That is supposed to be the comment if it asks you to comment on the policy. The 60% contribution means additional revenue minus the variable cost. For example, it's just like if you are selling something for $100, a 60% contribution will mean that of the $100, $40 will be the variable cost, and the rest of the $60 will be your saving. That is what contribution is. Osama, did I answer your question? Okay. Okay. Should we move forward? Yes, Rubed. This is what is the relevant costing approach is all about. We have to show the incremental impact of having a policy. Okay, let's move forward. We have another question that is related to Miller-Orr model. So for Miller-Orr model, let us go to the handout first to let me quickly explain what is the Miller-Orr model. I hope the handout contains the graph of the Miller-Orr model. We don't have the graph of the Miller and Orr model. Okay. Okay, it will be easy to explain it with the help of a graph. So let me explain with the help of a graph, the Miller-Orr model first. Otherwise, it will be difficult for you to understand how we solve the question. Okay, I've just tried to quickly draw the graph. Okay, just look at this and I'll just try to explain it quickly. The Miller-Orr model is basically a model that helps you in managing the cash, right? So it's basically a suggestion for any business is not to hold too much cash in hand. So what usually companies do is that they keep cash in hand, and then they invest some part of their cash in marketable securities. That is investments that can be converted into cash within 3 months time, which is we call them marketable securities, right? So they can easily be converted into cash by selling the investments. So Miller-Orr model basically is a cash management model which tells the company how much worth of investment should the company sell each time when it needs cash, and how much should it invest when it feels that it has a surplus of cash available, right? So I'll just explain it with the help of this graph. So the Miller-Orr model says the first thing that a company should do is to set its lower limit of the cash. And this limit is always set by the management. The Miller-Orr model will never suggest the lower limit. Remember this. So the management has to decide that what should be its minimum level of cash that it should keep. So in this example, I've just, for the sake of explanation, I've just decided to have a 20,000 cash balance. So just assume that a company feels that it should have at least 20,000 its cash in hand. Okay. Then I've just set a return point and then the upper limit. How these are calculated, for that we use Miller-Orr formula. For the time being, I'm not going to the formula. I'm just going to explain these things, and then we will see how we can calculate them. So a return point and then the upper point. So let's say the upper point is 80,000 and the return point is 40,000. For the time being, just assume it. Now, the difference between the upper and the lower limit is called the spread. This is called spread. So in dollar terms here, it is 60,000, right? 80,000 minus 20,000. So this is spread. Okay. Now, what this whole graph is telling you, according to this graph or Miller-Orr model, in this company's case, what will happen is that the cash balance of the company will fluctuate from time to time, right? It will be making sales, it will be recovering the cash, it will be getting cash, and then it will be paying for its expenses. So the cash balance will be going up and coming down. Now, according to this particular example, what does the lower limit mean? The lower limit means that whenever the company's cash in hand balance touches this lower limit of 20,000, it means that the company will be going into trouble. Therefore, now the company should increase its cash balance and get back to the return point, which is 40,000. So if it touches 20,000, how much more cash it will need to get to 40,000? Just quickly tell me, how much further cash it will need to get back to 40,000? 20,000 more. Now, how is the company going to get these $20,000? By investing more cash or by selling the existing investments? Exactly, by selling the existing short-term investments. So the moment the cash balance of the company touches 20,000, the Miller-Orr model here is suggesting that the company should sell $20,000 of investment so that it gets further 20,000 cash and its cash balance reaches to $40,000, the return point. But unless and until it touches 20,000, it has to do nothing. So for example, if a company balance is 21,000, what should it do? It should do nothing. It should wait for its balance to get back to 20,000. The moment it touches the 20,000, it should sell investment worth of $20,000 to get back to this $40,000 mark. And as long as it stays above 20,000 or below 80,000, it should do nothing. So if the cash balance is fluctuating between 80,000 and 20,000, the company should do nothing, neither selling nor buying. Okay, then there may be times when the cash balance will go to a height of 80,000 and it touch the 80,000 balance. Tell me, when the cash balance gets to the 80,000, what should the company do? Should it get back to 40,000 or not? it should get back to 40,000. That means it has to reduce its cash balance. Now, how can it reduce its cash balance? It has to invest. How much it has to invest? It has to invest 40,000 out of 80,000. So out of 80,000, $40,000 will go into the short-term investments, and the rest of 40,000 will be kept as cash in hand. And this is how it will move. And this is how the Miller-Orr model suggests. Now the point is how these figures have been calculated. This is what we need to now understand. Now this spread, look at this spread. This spread is basically the difference between lower limit and the upper limit, right? So how is this upper limit being decided? What are the factors that will allow you to decide this upper limit? Now, quick questions from all of you, just give me the answer. If there are high fluctuations in the cash balance, high fluctuations, that the cash balance is going up and then coming down, what do you think? Should the upper limit be higher or should the upper limit be lower in case of high level of fluctuations in the cash? Higher, yeah, to cover those fluctuations, right? You need to have a higher upper level. The reason is when you have fluctuations, high fluctuations in your cash movement, and you keep a lower level of upper limit, it will result in more transactions, because you will be selling you'll be investing more often, and by investing more often you will be increasing your transaction cost. But each time you invest or sell an investment, there will be transaction cost. So no company would like to have more transaction cost. Therefore this limit should be kept on a higher side to cover the fluctuations. So the fluctuations will statistically be called variance. We call it variance. So if there is a high variance, you may write this. If there is a high variance, the upper limit should be higher, which means that the spread should be higher. So the variance has a direct relationship with the spread. The higher the variance, the higher the spread. Is it clear? Is it clear? Okay. So if a company has a higher variance, it should have a higher spread. Okay, number one. Number two, let's go for another thing. Tell me one thing. Every transaction, whether you are selling the investment or you are buying the investment, it will involve transaction cost. You have to pay commission to the broker or any other cost. So selling and buying will always involve transaction cost. Now tell me, if a transaction cost is higher, if the transaction cost is higher in a particular company's case, should that company frequently buy or sell, or should it not buy frequently? It should not buy or sell the investments frequently, as it has more transaction cost. And this will only be possible if it has a higher upper limit or a higher spread. So it means a higher transaction cost should have a higher spread. So there should be a higher spread. So again, transaction cost has a direct relationship with the spread. So two variables will help you decide how much should be the spread. Number one, the variance. Number two, the transaction cost. So if the variance is high, the spread should be higher. If the transaction cost is higher, the spread should be higher. So these two variables have a direct relationship with the spread. Now, if we have an upper limit, let's say if instead of 80,000 we have 100,000 upper limit, it means we have to wait for a cash balance to get to $100,000 before we can invest. So it means we will be holding more cash. So the higher the upper limit, it means the higher we will have the cash balance. And if we have the higher cash balance, that is higher cash in hand, we will be losing the investment opportunity. We'll be losing the investment opportunity. Now tell me, if the rate of investment, the interest rate is higher, can we afford to have higher cash balance? No. So we should not have a high upper limit where we have a higher interest rate, right? So the higher the interest rate, the lower should be the upper limit, or in other words, the lower should be the spread. So interest rate has inverse relationship with the spread. No company can afford to have a higher spread or higher upper limit where the interest cost is higher, because if you are holding more cash and interest rate is higher, it will increase your finance cost. So every company will prefer to hold less cash in case there is a high finance cost. Is it okay? So how many variables are there in total to decide how much should be the spread? How many variables are there? 3 variables. The names of the variables are variance, interest, and transaction cost, right? So variance and transaction cost has a direct relationship and interest has the inverse relationship. Therefore, the formula of spread should have two things in numerator and one thing in denominator. Which two things should be in the numerator of the spread formula? Which two things should be in the numerator of the spread formula? Because those two things which have a direct relationship should be in the numerator mathematically: variance and transaction cost. And interest should be in the denominator because it has an inverse relationship. So let's look at the formula of spread. Look at this formula. The transaction cost and the variance, they both are in the numerator, whereas the interest rate is in the denominator. So remember now this formula. And now you should know the rationale behind these two being in the numerator and the interest rate to be in the denominator. So remember this formula. Usually this formula will be given in the exam. So I explained this formula so that you know the concept of why these two things are in the numerator and why is the interest rate in the denominator. Okay, so since the question of Miller or model will be a straightforward question, so what you have to do is I'll share this Excel sheet with you on Google Classroom, which I'll explain how you can access on the WhatsApp group. I will explain after the class how you can access the Google Classroom. So this question is something that you have to attempt at your own. This part B of Ulnat company. This part B of Ulnat company should be attempted by you, right? It's a straightforward question. All the variables have been given in the question. All the details have been given in the question. All you have to do is to apply it in the formula. So this is your home assignment. So just note it down. Part B of Ulnat company. This is your homework. Link is not responding. Okay. Try to join the WhatsApp group directly. In case you fail to join, just note down my number, but don't I expect that a lot of students will be starting texting me. Only text me because it will be difficult for me to handle so many messages. So only text me in case you fail to join the WhatsApp group. So my number is +92 321 260 4033. So that's my number on WhatsApp. So in case you're not able to join the WhatsApp group, just text me on this number. I will just add you on the group. Okay, a quick feedback. If you people can just give me a quick feedback, just from 1 to 5. Tell me, 1 being poor and 5 being excellent. From 1 to 5, just rate how is the session so far. And be honest with the feedback. I don't mind, because a feedback is always for improvement's sake. So thank you, Mitchell. Thank you for being honest. That's what I really want to know. I just want to know what exactly you have felt about the session. It will help me, and I'll ask later on the WhatsApp group as well, that what did you think should be done to improve it further? Because my objective of this session is that when I end the session, most of you have gained maximum benefit from these 5 days. Yes, Jonathan, what was your question? Because there's so many questions come, so I may miss a question. Jonathan, can you just come up with your question again? I missed the definition of a variance. Okay, variance is basically the fluctuation in the cash balance. Few businesses, they will have less fluctuation in their cash balance because they will be receiving and they will be making payments, and the receipts and the payments will be somewhat matching each other and keeping the cash balance relatively stable. In few of the businesses, it may vary significantly. For example, one day it may have a $50,000 cash balance, the other day it may jump to $200,000. On the very next day, it may come up to it may come down to $20,000. So there's a great fluctuation. This is called variance. The variation in the cash balance is called variance. I have written my number on the screen. You have this number on my screen. This is the number, the WhatsApp number. Okay. So should we move forward? Okay. So we have a Gorva company question. It's a past exam question, and we have um, the following financial information related to Gorva company. We have this, the income statement, we have the balance sheet, and let's go back to requirements. Go to requirements. Use the above financial information discussed with supporting calculation whether or not Gorva company is over trading. Now, again, this is your home assignment. I will be discussing this question in the next class, because first one thing you have to do is you have to calculate few ratios. So I'm just writing the ratios. You have to calculate these ratios, and in the next class we will be discussing whether the Gorma company is over trading or not, because the beauty of this question is the discussion. So we will see, we will see whether the Gorva company is over trading or not. So what you are supposed to calculate is, number one, you have to calculate asset turnover. ratio. You have to calculate current/quick ratio. You have to calculate sales growth in percentage. So you have to tell how much has a sale grown up. 4, you have to calculate gross profit margin, operating profit margin. You have to calculate sales to working capital ratio to see how much sales do we have as compared to our working capital ratio. 6, you have to calculate the increase in OD in percentage. And what else? That's it. Okay, no, sorry. You have to calculate receivable, payable, and inventory days. That's it. So using this question, you have to calculate these ratios. And in the next class, with the help of these ratios, and you have to calculate it for both years, right? So in the next class, we will be discussing whether Gorva company is overtrading or not, looking at these ratios. So come up with the clerical calculation and then we'll be doing the discussion thing. Don't worry, after the end of the class, I will explain on the group how to join the Google Classroom to access all the material. This material is there, so I'll be explaining, don't worry. Okay, so the question that we are supposed to be doing today from this question is the C part. Evaluate whether the proposal to factor trade receivable is financially acceptable, assuming an average cost of short of finance. This part of the question only. Now, first, let me explain what is factor. A factor is basically someone who takes the responsibility of managing the receivables and also recovering the cash from the receivables. Usually a bank, because a bank is actually expert or considered to be an expert of recovering the amount, because this is what bank does. Bank receives, bank lends, and bank borrows money. So bank is considered to be a specialist of receivable management. So companies may think of outsourcing their receivable department or credit control department to a factor or a bank, so that it can spare some time for its core operations. And secondly, by giving something to a specialist, it will have more chance of recovery. So the service is called factoring, and the company or the organization that provides you the service is called factor. So a business at times has to decide whether it should go for a factoring service or not based on the costs and benefits attached. So just look at this question and let's see Gorva company, for a Gorva company, whether the factoring is a good option or not, but we will purely take the decision on financial grounds. Let's look at it. A factor as offered to take over the administration of trade receivables on a non-recourse basis. So I want you to note down one thing. There are two types of factoring services, a non-recourse and a recourse. A non-recourse factoring means that if any bad debts occur, that loss will be borne by the factor. For example, if I had $1 million of receivable and I have outsourced the $1 million receivable to a factor on a non-recourse basis, it means that the factor has to pay me $1 million either today or 1 month later. That depends on what type of arrangement we will have, but it has to pay us back this whole $1 million, even if any particular customer fails to pay back the factor. If any bad debts will occur, the company will no more be responsible. The bank is going to take the responsibility of the bad debts. That is called non-recourse factoring. The recourse factoring is, on the other side, a factoring service in which, in case a bad debts occur, the company will have to bear rather than the factor is going to bear. So, for example, out of $1 million, if $50,000 are proven bad debts, then the factor is not supposed to pay the whole $1 million. It will only pay 0.95 million, or whatever the amount is received. That is called recourse factoring. Now, what is there for a bank in the non-recourse factoring? Definitely, the factor will always charge a fee for both recourse factoring or non-recourse factoring, but the non-recourse factoring fee will be higher than the recourse factoring, because in the non-recourse factoring, it is providing credit insurance. Let's say if a recourse factoring fee is 2%, the non-recourse factoring will have a fee of more than 2%. That additional is for that credit risk, credit insurance. So remember to read this line. It's very important. Okay, let's go forward. For an annual fee of 3% of credit sales, the factor will maintain trade receivable collection period of 30 days. So if the company hands over its receivables to factor, the collection period will be 30 days. And Gorva company will also save $100,000 in administration cost and $350,000 per year in bad debts. It is going to save $350,000 bad debts as well. A condition of the factoring agreement is that the factor would advance 80% of the face value of receivable at an annual interest rate of 7%. So here the factor is also providing you the financing. Now we have to decide whether the Gorva company should go for this factoring arrangement or not. So let's do it. So I'm solving it for B part. Okay, it's B or C part. C part. Okay. First of all, let's write the benefits that we will be getting if we go for factoring. One of the benefits will be the saving in administration cost. So let's first write the straightforward things. What will be the saving in administration costs? Who's going to tell me? What will be the saving in administration cost? What will be the savings in administration costs? $100,000, right? Okay, it's going to be $100,000. Okay, then bad debts will be saved, and a very straightforward figure, 350,000. Okay, again, let's see whether there will be any saving in the finance cost, because we have to see how much will be the receivable figure after factoring. Yes, in this case, factoring is also providing us the finance because they are paying us in advance, and also they are helping us recover the amount from the customers. Okay, so now let's calculate how much is the existing receivable, and I'll just do the calculation here. Existing receivable, and then we'll see how much will be the receivable after with the at the moment 100% of the receivable will be financed by the existing arrangements of the company. So what is the existing receivable figure? We have to look at the balance sheet. We have to look at the balance sheet. The receivable figure for the current year is 4600,000, right? Here we go, 4600 for 2007. We have to pick the recent year. The previous year is always for comparison's sake, so we will be picking up the current year. 2007 trade receivable 4600. So we have 4600,000. Okay, that's existing receivables. So the finance cost on the existing receivable will be, let's check it out. We have been provided with two types of finance cost, if 5% and 8%, but we had a note, assume an average cost of short-term finance in this part of the question only. So it says that you should consider this 5% as your cost of finance. So it has cleared it because there were two rates of finance. Usually for working capital management, we use the short-term finance. So here it has mentioned as well. So 5%. We don't have any other finance cost, right? No. Here we go. We have, yes, it's 5%. So 5%, 5% of 4600 is the existing finance cost, 230,000. Now let's calculate finance cost with factor. Okay, when factor will be there, what will happen is you will have to calculate your receivable figure first and see how much of the receivable will be financed by factor and how much will be still financed by the current source of financing. So first of all, let's calculate the receivable figure, revised receivable figure. The factor has ensured that the period will be of 30 days, right? So the receivable figure will be 30 into sales. What's the sales figure? 37,400. 37,400 divided by 365. So this will be your revised receivable figure. Now, not whole of this will be financed by the factor. So finance cost charged by factor. So how much was financed by the factor? 80% of the receivable. So 80% of this figure will be financed by the factor and he will charge 7%. So that's the finance cost of 80% of this figure. Then cost charged by the bank, let's say, which will be 20% and the rate will be 5%. So the total cost of finance with factor will be, I should write with factoring, 20288. Now tell me, is it a reduction or is it the increase in finance cost? Quickly. With the factoring, is it increasing or reducing? There is a reduction because it used to be 230,000, but with factoring it is going to be 2028. So we should write it as a benefit. So we should write as saving in finance cost, which will be 230,000 minus 20288. So 27188 is going to be the saving in finance cost. So we don't have any other benefit attached with the factoring. So we just need to sum all these to get the total benefit. That's the total benefit. So that's the total benefit. So Now let's go to the cost. Less costs. Now the costs will be the factor's fee. The cost will be the factor's fee. The cost is going to be the factor's fee, and the factor fee is 3% of the sales. The cost is going to be 3% of the factor's fee, and 3% of the sales, right? 3% of the sales, sorry. 37,400,000, and it should be 3%. So too much. Okay. So this is the fee that the factor is going to charge us, and this is what we will be saving. So if the company goes for factoring, I hope I haven't overstated anything. No, it's okay. So the benefit minus the cost. So we have additional cost of factoring is 644,882. So what should be the decision? What should be the decision? Since it will result in additional cost of $644,882, therefore on financial grounds the company should not go for factoring. Okay, so let me give you a quick recap, and then we will end the session for today. So first of all, the existing receivable figure, I just picked it up with from the balance sheet. Here we go, 4,600. And I just took 5% off this figure to get the existing finance cost figure. Then I went for the revised finance cost, but for that I had to calculate the revised receivable figure. So what I did, I pick up the 30 days of credit period because the question told us that there will be a credit period of 30 days with factoring. So I just multiplied it with the sales figure and divided by 365 to get the revised account receivable figure. 80% of this figure will be financed by the factor. So I just took 80% of this figure and then took the finance rate of the factor 7%. 20% of this figure will still be financed by the existing bank at a rate of 5%. The total finance cost after factoring will be the sum of these two. Here we go, 202,882. The existing finance cost was 230. The finance cost after factoring was 202,888, which is less than the existing one, which means that we were saving because of factoring. That's why I showed it as a benefit here. 230 minus 202,882. Here we go. That's the difference. 2722. The administration cost was a straightforward thing. The question told us that there will be a saving of $100,000 in administration cost, and bad debts cost was, I hope I've correctly written the figures. Yes. So 350 and 100,000. These were straightforward figures picked up from the question. Finance cost saving, the total benefit, the sum of all these three. Then I took the factor fee, which was a straightforward thing again, a 3% of the sales figure. So that was the cost and that was the benefit. The difference of the two was the additional cost, and therefore the decision will be not to go for factoring. So from 1 to 5, just tell me, is it clear? Yes, Wakas. In case of non-recourse factoring, bad debts won't be borne by the company. It will be borne by the factor. Yes. It's the difference of the existing finance cost and the revised finance cost. Cost by factor is not really clear. I didn't get, Jonathan, your question. What is the question? Where is the 7% from? 7% is being given in the question here. It's there. Here we go. A condition of the factoring agreement is that the factor would advance 80% of the face value of receivable at an annual interest rate of 7%. Asad, I told you that I will give you access to Google Classroom where all the handouts are available. So you can just simply download these from the Google Classroom. So it's a charge. Okay. Yes, it's a charge. That's why I've calculated it here. So it's a cost, right? This is the cost. That's the cost. So we have two types of cost after factoring. We added these two. But when we compared it with the existing cost, we saw there is a saving. The existing cost was 230,000. After the factoring, it will be reduced to 202,882. So which means that there will be a saving in the finance cost because of the factoring. So I've just taken the difference of these two and showed it as a benefit. Yes, that after factoring, 20% of the receivable will be financed by the bank. Here it is. 20% of the receivable will be financed by the bank at a 5% rate. Okay. So feedback form will be shared by the management with you. So do fill the feedback form. If you are unable to join the group, that's my WhatsApp number. Just drop me a text. I will add you to the group. But if you can use this QR code, it's very user friendly to join to this QR code. Yes, I will upload this file on the Google Classroom from where each one of you will be able to download this file. What I will do is I will keep the empty file, also this solved file. So what you can do is you can try all these questions yourself using the empty file and then compare it with the solved file. Wakas, usually factoring is not considered a good practice as it creates badwill for the company for several reasons. Number one, if you go for factoring, it is an indicator that you have financial problems. So nobody would like to get a image of having financial crisis. Number two, since the people with whom the factor is going to deal are your customers, not the factor's customers. So do not expect from the factor that they will be humble, they will be very they will be dealing very courteously. So definitely they will have only one time to deal with those customers and they can deal it anyway. So it will create a bad image for the company. So a factor is usually selected once the company is really in a financial problem. Otherwise, usually the companies will not go for the factoring. Well, the recording of the session will be available on ACCA Pakistan's Vimeo channel. So it will be available. The link is there. So every next day, you will be given the access to video lectures. So I hope everybody has joined the WhatsApp group. So I'm coming to the WhatsApp group to explain how you can join the Google Classroom. For now, I'm just ending the session as we have approached to the end of the session, and we will be continuing from this point tomorrow. So have a good day. If it's a daytime there, it's night already here. So good night for me and good day for everyone else. Okay, I hope the session was useful. Take care. Bye-bye.